This is a great turnout. I wasn't sure what the turnout was going to be like being on this early in the day. I had my mum on standby to stand in the front row and clap loudly for me just in case nobody came, but this is good. I've ditched her. So welcome. So full disclosure, I am here today to spruik my product at the end of the day, the Airlie Australian Share Fund. But I also want to start with a bit of a defense of my asset class, Australian equities. It sounds a bit boring, and I'm conscious that, today you're going to hear really exciting pitches from crypto products, from global products. So I want to make a case for the humble Australian company. I get it with crypto. It's new, it's a whole new payment system. But in Australia, we have some innovative financial models as well. When you're looking at global companies, they're going to sell you that you can invest in these great mega trends like tech and cybersecurity, but there are local plays on cybersecurity available here. And I get it, you want to invest alongside the billionaires like Elon Musk and Jeff Bezos, but you can do that here as well. You can invest alongside some really nice local Australian billionaires. You probably just don't want to see some of them succeed quite as much. So, look, I think there's something to be said for investing in companies that you know and understand as a local and as a consumer. So don't write off Australian equities. But obviously that's not all there is to it, and that's where we come in. So I work at Airlie, and I work on a product called the Airlie Australian Share Fund. So it's listed on the stock exchange under the ticker AASF. And basically it's a fund that finds between 25 to 35 Australian companies and invests in those. So I wanted to pick this topic today of risk versus uncertainty because I think it gives you a helpful view into how we pick stocks and how you can pick stocks yourself to minimize risk and maximize the opportunity set that uncertainty gives you. So I want to start with a show of hands. How many people in the room have invested in a company where the shares have gone to zero? I'll put my hand up because I definitely have. Right, well, it almost counts. I think the people that had their hands up are going to end up being the best investors in the room at the end of the day because you've learnt a really painful, really powerful lesson about the difference between true risk in investing and uncertainty. So these things are not the same thing, but the market hates them both and treats them both equally. Risk is the chance of permanent capital impairment. So risk is the chance that you do not get your money back. Uncertainty is you don't know what's going to happen next. And I think when you hear it defined that way, it's pretty clear that uncertainty, it's a part of investing, it's always a part of investing, and it's a part of life. So there's nothing we can do about uncertainty, and actually, hopefully, at the end of the day, you'll think about uncertainty as your friend. That's what creates opportunities in investing. But risk is not your friend. You really want to minimize risk. So I want to outline some rules today for minimizing risk in investing. But before I get into that, it's important to note that we're never going to be able to bring risk down to zero. So if you want a zero risk investment, you put your money in the bank, or maybe you stick your money under the mattress, and you're probably thinking, well, the reason I don't do that is because I don't get a return from that. And that's what the risk curve is designed to do. You're pushed out along the risk curve to the tantalizing returns that are available in equity land, but you can't achieve those returns without recognizing you're taking risk purely by investing in equities, because equity holders obviously rank below debt holders in the stack. So there's no guarantee that your equity is worth anything. So this is a risk, this is an inherent risk in investing. We can't, minimize it away, but there are things that we can do to minimize the chance that you will permanently impair your capital, and then the chance that you're going to have a good time investing over the long term. So uncertainty by contrast, I want you to think of uncertainty as your friend. So on the screen this is the top 20 Australian companies, their 52-week highs and lows in the year 2019. And I wanted to pick the year 2019 because in retrospect, it's probably the last boring year in all of our lives. Like I don't know about you, but I can't remember one thing that happened in 2019. And yet, the top 20 most boring Australian companies have seen their share prices change by 54% on average in that year. And if I do this analysis for 2020 or 2021, that number's even larger. It's moving towards more 70 or 80%. So we think of the top 20 stocks as the most boring companies, and we know that companies, their value changes over years and decades, but their valuations and their share prices are fluctuating rapidly in the market. So we know that the true value of these 20 businesses hasn't changed by 54% in 1 year. So we know that some of these assets have been mispriced. And that's what gets me excited about investing, the fact that there's always this opportunity set out there because of uncertainty, because of not knowing about the future and everyone guessing about what's coming next and pricing those guesses into share prices. So we like uncertainty, but we don't like risk. So 4 rules today for minimizing risk in investing. The first rule is focus on financial strength. I'm going to say a lot of stuff today, but if there was just one thing that you could take from this whole presentation, just one rule, humor me. Please just buy companies that make money. Just buy companies that generate profits. If you do this one thing, you will avoid the riskiest part of the market. And you might be thinking, okay, Boomer, my specky lithium stock is up 8-fold in the last year and it doesn't make any money, so what do you know? And to that I would say, firstly, ouch, I'm not a boomer, I'm one of you. And secondly, the reason that I say just avoid companies that are loss-making is because they have the worst track record of performance. So a broker created this portfolio and he called it the Birds Without Wings portfolio. And all he did was he bought every loss-making company listed on the ASX every year from the year 2000. So let's have a look at how that portfolio went. It's the blue line. So if you invested $100 in the year 2000 in every loss-making company on the ASX, today your portfolio will be worth 24 cents. And if you just invested in the index, this is the power of compounding, this is why we love equities. If you just invested in the index, your $100 would be worth nearly $600 today. So there are discrete periods of time where loss-making companies do very well. And the most recent time, coming out of the pandemic, this Birds Without Wings portfolio was up 60% in the year from when markets bottomed in April 2020 to the following year. So there are small periods of time where this really works, but the longer trend is so stark. So, you really have to have these facts in your back pocket because these are the most enticing stocks. They're your biotechs, your explorers, your tech stocks. They all paint you the world because their business model is for you as an equity holder to fund them because they can't get debt holders to fund them. So the clue is if you're invested in a company that continually is raising equity, usually they'll put out a great announcement, then they'll raise equity. They're selling you the dream. None of these companies are going to be the next Afterpay. I mean, to be honest, even Afterpay didn't turn out to be the next Afterpay. So if you just avoid this section of the market, you will do yourselves a great favor in terms of long-term value creation in investing. So just buy companies with good balance sheets that self-generate and self-fund their operations. The second rule is don't overpay. So everyone thinks about the tech wreck back in the year 2001 as tech stocks losing about 90% of their value. But it was actually more widespread than that. So on the screen here you can see Procter & Gamble, Disney, McDonald's, a lot of non-tech companies saw 60, 70, 80, 90% share price declines. And interestingly, if you'd invested at the peak in a lot of these companies, it would have taken you between 6 to 17 years to get your money back in terms of recouping that initial share price. So if we think about that initial definition of risk as permanent capital impairment, i.e. you don't get your money back, that can happen because the equity's worthless, like the painful experience I had, or it could happen because you just never see the share price that you paid for the shares again. So this risk is really elevated at certain times in the market. And I'd argue probably a year ago, this risk of overpaying across the board was quite elevated. And so, these were good companies, but they were swept up in a bit of a mania. The good news is, the flip side of that is, when markets are falling and everyone's really, really pessimistic, you've got a much better chance over the long term of making good money. If you read the headlines, you'll convince yourself not to invest. You'll convince yourself that you've figured out that the global financial system's about to go down the gurgler and you're better off sitting on the sidelines. But the reality is, if you're planning on investing for decades, just buy the companies you like and don't worry too much about whether or not you're going to be able to pick the bottom. You won't be able to pick the bottom. I won't be able to pick the bottom. None of us will. But I think right now there are some good valuations available in the ASX. I think there are a lot of companies that you're going to make good money on a 3 to 5 year view, probably very good money on a 10-year view because of the pessimism that's everywhere in the markets. So things could get worse in the short term. As long as you don't need the money back, that's the power of personal investing. Is you don't have to pick the bottom. You can just sort of set and forget. And I think that the valuation opportunities right now, across the board, sort of let us avoid the risk of overpaying. The third rule is buy quality businesses. So what do we mean by quality? For me, a quality business is one that can generate a high return on capital. So competition theory basically says that if I make a high return on capital, competitors are going to see that, they're going to come into my industry and they're going to bid that return down until we're all just making average returns. So when you can see a company that's made a sustained high return on capital for a long time, it's like a big sign saying there's something special going on here, because for some reason then the competitors aren't able to come in and eat that profit pool. So that's when we look at high returns, and that's when we get in there and we do the work and we try to understand what's the barrier to entry, what has this company got going for it that's special, and then we make a judgment on how long we think that can last. So we like quality companies, but there is a bit of a tension between this rule, buy quality companies, and the rule I just outlined of don't overpay. Because obviously, often, when a company's quality is obvious, they're the most expensive companies. And so you get through periods of time where the market really, really re-rates these high quality companies. If I went back to that slide, if you'd correctly identified that McDonald's and Disney and Microsoft had the best prospects amongst the best prospects of the next few decades, it still took you nearly 17 years to get your money back. So there is a relationship between quality and valuation that you do have to pay attention to. So that's why at Airlie, our way around this is to look for undervalued quality. So we're looking for quality businesses, but we're looking for situations where it's not obvious. Now, there's no one-size-fits-all reason why it's not obvious. I'll give you a few examples. So there's jewel in the crown scenario. So this is when you've got a good business, but it's lost within a less good business. So one recently would be Wesfarmers. So Bunnings, before they demerged Coles a few years ago, Bunnings was about 30% of group earnings, but it is far and away the best business within Wesfarmers. It's actually one of the best businesses in Australia. So most companies make about a 10% return on capital. Bunnings makes 70%. So it's an incredible business. They've easily got the best sausage sizzles in Australia, and it's a really, really good one. But it was only 30% of the group within Wesfarmers when they owned Coles. Coles was the dominant. It was about 50% of group earnings. So when they demerged Coles, if you're a shareholder in Wesfarmers, you got your Wesfarmers shares, you got your Coles shares, but Bunnings went from 30% of Wesfarmers to 70% of Wesfarmers earnings. So because it was such a good business, the market was suddenly like, oh, this business is worth way more because it's now the predominant driver of earnings, and it re-rated the company. And you can see that all the performance for the company has come since that demerger. Another example where you might find undervalued quality is when you've got a good business, but it's in an unloved sector. So one company that we've owned for many years in our fund is Mineral Resources. And the heart of Mineral Resources business is a mining services business. Now, most mining services businesses are terrible. They have really, really low returns, and that's because they're tied to this chart on the left, which is mining capex. It's really boom and bust. So the majors will say, we want to build a big project. They'll put it out to tender. Mining services companies will come in and say, oh, we can build it for $500 million. They'll win the contract, they'll build it, the work will be finished. It evaporates. So, when there's work, they make money when there's work going on, and they make no money the rest of the time, and a lot of these businesses end up going to the wall. Mineral Resources mining services business is linked to production. And if you look at commodities production in Western Australia, it's that chart on the right. It's been a structural growth story because of where these assets sit on the cost curve. So Mineral Resources does crushing for the majors. So if you go to BHP, one of their mines, for example, a chunk of their mine is run by Mineral Resources, doing the crushing portion of the mine. So if they weren't happy with Mineral Resources, or they thought they were paying them too much, and the contract was coming up for renegotiation, and they wanted to bring someone else in, Mineral Resources owns that part of the mine. So they'd have to pack that up, lose it. Mineral Resources would take all the kit, and then they'd have to bring in someone else, bring up that part of the mine. So you'd probably lose 6 months of production and all the operational risk in the meantime. So it just doesn't happen. They just don't lose contracts. So they've been able to, they're embedded within their customers, and they've been able to make really, really good returns because of that. So this was a situation where it was priced in line with all its mining services peers on about 5 times earnings, even though it was a much, much better company. For 20 years, it's generated a return on invested capital of around 22%, whereas most companies in Australia generate 10 to 12%, and most of these mining services companies more like 4 to 5%. So it's much, much better than its peers, really, really cheap because of that. So that's one where we thought there was undervalued quality. It's been a really good performer. It's up about 4-fold, and we got lucky on the iron ore price and then the lithium price, but the core of the business is a really powerful, steady cash flow generator, and the management team have been really smart about what they've invested that cash into. Another situation where you might find undervalued quality is just an under-the-radar business. So I don't know where the logo's dropped off here, but this business is PWR, which not many people have heard of. So it's this little Australian company based in the Gold Coast, and I don't know if anyone here has watched Drive to Survive on Netflix or is a fan of, a lot of the women, I like that, a fan of Formula One. But you're really surprised to find out that this Aussie company is supplying every single one of the Formula One team's cooling systems. So 15 years ago, they started with Red Bull. And then the year that they supplied Red Bull with their cooling systems, Red Bull went on to win 6 years in a row. Red Bull say it was Sebastian Vettel, PWR say it was their cooling systems. There may be some truth in that because they've then gone on over the next 15 years to get every single Formula One team. So they've now just got Mercedes in the last 2 years, and now they are the monopoly supplier of cooling systems to all of these teams. So that's half the business. That's a really good business. And that the engineering know-how and the ability to sort of invest at the leading edge of technology for these very fussy customers throws off all these other opportunities, and that's the other half of the pie. And that green piece of the pie, emerging technologies, is growing very, very fast. They are tackling electric vehicles, they're tackling aerospace, they're tackling defense, really, really big end markets. So that's one that we think is really exciting. And it's under the radar because it's this owner-managed business. And so the original founder of the business is still running it today. He was a mechanic, and he and his son thought, well, we could probably make some cooling systems. And then, 40 years later, they're making the best cooling systems in the world, supplying Formula One. So it's this great Aussie success story. And it was interesting, actually. So during reporting season, we met with pretty much every large corporate in Australia, and every single one of them was talking about how much trouble they're having right now finding good people. And we met with PWR, and they were saying, oh yeah, we basically just get engineering rev heads who are desperate to work for us because they love Formula One. And they had this great story in their annual report about this guy who was in his second year working at PWR, a young guy, and the Haas team had an issue in their qualifying round in Saudi Arabia, and they needed a part made. So PWR worked through the night. They made these parts, they gave them to this guy, flew him to Saudi Arabia, he hand-delivered them to the Haas team, and then they took him around that weekend to the Saudi Arabian Grand Prix. And I don't know if anyone watches Drive to Survive, but there were probably a lot of F-bombs flying around because the team principal of Haas, he's got a real potty mouth. That's just so cool. If you're into cars, you just can't compete with that. So these companies, these owner-managed businesses often have these really unique cultures that can help them attract talent and help them attract loyal talent that stay with them for a long time and underpin sort of the high-end engineering that's being done out of this business in Queensland. So actually that dovetails nicely into my fourth rule, which is management matters. So at Airlie, we're really big on investing in owner-managed businesses. It's not the only thing that we invest in, but when we find a really good business that's run by its original founders, we get really excited. One that we've owned for many, many years is Reece. So Reece is Australia's largest plumbing wholesaler, and they've been owned and run by this one family since the 60s, the Wilson family, and they own about 60% of the shares on issue. So again, it's a bit under the radar, they're not that promotional. And if you look 20 years ago, Reece was actually half the size of the dominant player in the market, which was TradeLink. And over the next 20 years, Reece just had their head down, one management team, they invested in stores, they invested in what their customers wanted in technology and the like. And TradeLink went through many different corporate hands, had many, many different management teams, and the results of that, over 20 years, sales are up 8-fold at Reece and profits up 22 times. And amazingly, sales are flat since 1998 at TradeLink. So I'd put that result down to the focus of the management team, and it's a really good example how, so the guy that I work with, Matt Williams, he's owned this stock in every permutation of his funds over the years. So he's enjoyed this ride in profits, and it's a 50-fold increase in the share price over this time. So when you find a good management team and they're focused on the long term because all of their family wealth and reputation is tied up on it, that's really special, and you can get some really good results. So we're always looking for really good owner-managed businesses to put into our fund, and it represents about 1/3 of our fund at the moment, our owner-managed businesses. So we wanted to back test this because we'd anecdotally felt as though owner-managed businesses outperformed. So we wanted to test it. So we screened the market for businesses that had over 10 years listed history and they were run by their original founders. And we had a look at the performance of that index, and it's up 11-fold since 2008. And if you just invested in the normal index, it's up 2-fold. So it dramatically outperforms. So we think when you find owner-managed businesses that you like, that are high quality and they have good balance sheets, that's tick, 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 tick. Now look, because we're amongst friends and it's a Saturday, I'm going to let you in a little soft rule that we also have at Airlie, which was foreshadowed. We have a rule not to invest, well, a soft rule. Don't invest in a company where the CEO is really hot. So to give you some examples, this company, Vocation, it was an IPO. This CEO, he looks like a Hemsworth brother. The IPO lunch, they say there's not many women in funds management. I tell you what, we were all at that lunch. It was standing room only. And within 18 months, the stock was zero as government pulled funding to that sector. OnePage, a tech company run by a very attractive lady, it was too small for us to invest in, and yet my male colleagues kept saying, Emma, I really need to take a meeting with this company for some reason. Again, ended up being a big fat zero very quickly. So if the CEO is a hottie, the stock is a noddy, and rest assured, most of the companies that Airlie are invested in are run by absolute mingers. I have to word that really carefully in case I get a call on Monday, oh, you called me a minger at FinFest. I said most of them, most of them. So in conclusion, uncertainty creates opportunity investing. Uncertainty is your friend. You need to lean into the fear that crops up every now and then in markets, because that's when you're going to make a really good return if you've got your eyes on the prize, which is the long term. But there are some things you can do to minimize risk. So if you buy businesses that have good financial strength, that make money, you don't overpay for them, you buy quality businesses, and you focus on finding good management teams, then you'll go a long way to having a really good time in investing. So I'll leave it there, although one other thing I'd say is we've got, Amber Kirk's got the details, but we've got a competition to win $2,000 in the Airlie Australian Share Fund. And markets are tough. I might enter this, actually. It's been a hard year. So you've got the details on it, so I'll leave it to you. But thank you. Thank you all for coming.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.